All right. We're back for another episode of the YVR REMO show. Today we have myself, Dean, Derek, and Justin. Tyler's out getting married, so the three of us are going to handle this one. It's been a big week, to say the least. The Bank of Canada has done it again. They have decided to raise the overnight lending rate by 1/4%. It's the first raise in about 130 days. So it wasn't much of a pause. And for a lot of experts thinking this was the peak, we're slightly above the peak now, and in fact, the markets are now pricing in potentially another increase. So, with all that said, a lot of uncertainty around what the Bank of Canada is going to do, what the government's going to do in general. We're going to chat today really about what we can control, and those are the options that we have at our disposal. So, looking forward to kind of sifting through this uncertainty and finding certainty in the options that our clients are taking advantage of today.
There's nothing positive about what's happened here, right? Everybody consistently across the board, like Dean mentioned, even like 90% of the economists in our country, we're not predicting this. So, all you can do is deal with it, right? There's nothing we can do to change it. Everyone was of a pretty positive mindset for the last 2, 3 months kind of thing. Things seem to be going in the right direction. Variable Bank of Canada had stabilized. Fixed rates were actually trickling down with the bond yield. The markets were picking up, like anyone that's especially local market. But from my understanding, this is pretty much everywhere across the country. There were inventory issues, which caused multiple offers, and that was driving prices back up, right? So good and bad in that, but everything seemed to be going in the right direction. And then, of course, some of our economic numbers came out and they weren't going in the direction that the Bank of Canada had hoped. And like we've talked about many times, the only tool that our government and our country has to try to turn things on and off is interest rates, right? Like that's literally the only piece that they can control to try to sway markets and keep things going in the direction that they wanted, which is essentially down, right? Getting inflation down. So again, just, addressing the elephant in the room, nothing good about it, but how do we deal with it, right? And what comes to my mind, and just to be frank, like I know everyone's looking for advice and strategy, and I think that in situations like this where the market's so volatile and like unexpected dramatic changes are happening, in my opinion, you have to take the strategy out of it a bit. Like obviously you need to focus on numbers, but at the end of the day, like how do you build a strategy if you don't know what's going to happen next, right? It's pretty tough to do, and you're building a strategy around predictions and expectations, which could change. So that said, I think you got to circle back, and I'm speaking primarily to the people in variable mortgages, myself included. And I believe Dean and Justin also have variable mortgages, so I'm talking to you guys too. You got to kind of take that strategy out of it and figure out like what works for your situation, right? Strategically or based on your financial position, like are you in a position to stay in a variable and take the risk that there could be another rate hike or another two rate hikes? Like, and if you're not, right? Like if that would put you in a position where you can't afford life anymore, and as much as the last thing you want to do is go fix because that wasn't the original strategy that you chose, does it make sense to do that now just to put yourself in a better position to get through what's going on, right? So I think you really need to go back to the basics and worry about yourself and your personal situation and your finances to make sure you can get through this, because as we all know, like being put in a position where you have to sell your house because you can't afford the payments in a down market, you can lose a ton of money, right? Like equity is going to be down if values are down, right? So I know we're going to dig into this in much more detail, but just kind of my initial thoughts.
To give a little context too, before we dive into too much of the strategy, like it was alluded to before, 90% of the economists in the country didn't expect this coming. It was only 60 days ago when we saw 100% guarantee almost that we were going to see rate hikes coming in July, and the market quickly shifted. Now this is, I think we all agree that this is a very knee-jerk reaction to some numbers that came out not too long ago by the Bank of Canada, but it's pretty evident that they are really wanting to force this recession to really get inflation under 2% as soon as maybe Q1 of next year potentially, right? So I think they've made what they're trying to do very apparent to us now, and that now we have to kind of go into like the strategy talk like Derek has mentioned, but we can't really guess what's going to happen in the future. Are we going to see cuts sooner? Are we going to see more raises? So, like Derek alluded to, we definitely need to look at you, individually each single time, and see like, hey, what makes sense for you? Locking into that 3 or 4 year term or 2 year term, is a refi debt consolidation more up your alley? Is maybe going to a potential alternative lender and extending amortization farther a better opportunity for you? Like, every situation is going to be specific to you, and an in depth conversation with us at Thrive is what you're going to need going forward.
The three buckets that we can cover here would be like from somebody that's in a current variable, whether it be an adjustable rate mortgage where your payments automatically change, or a true variable with a static payment. The three kind of buckets that you have as options, which is what we'll dig into going forward. You either stay variable, right? Like you ride the wave, you hope for the best, you hope rates come down sooner than later, assuming affordability aligns for you. You look into conversion options. So if you're in a variable, you can convert your mortgage into a fixed at no cost with your current lender. Pros and cons to that. And then the last piece is doing a full-on refinance, which is redoing your mortgage, potentially going to a different lender, and lots of other good options if you go that route, but there is a cost. So why don't we just kind of start on the like staying variable, like the play in that and the mindset in that for anyone that chooses to do so.
Yeah, for some people, this could make a lot of sense, especially for those that want to hedge their bet that the rates are going to drop sharply next year. Even with the price increase, or sorry, even with experts, including a rate increase this year in kind of what they're looking at from a market perspective, the election is coming up next year in the fall, and it's quite common for a federal government to look at making things look a lot better from a perspective of getting votes, and going to the polls as of today. I don't think it would look as good for the current government as it may a year from now if rates have come down significantly and things are starting to look better. So just given it's election year, it's very much hypothetical, and it's a guess, but I would have to guess that the rates are going to go down next year, just given those factors. But if inflation does stick around and it gets, we continue to see upticks there, I mean, they will have no choice. They won't be able to play that election card. But let's just say you are that individual that wants to hedge their bet on that. It could make sense for you to wait this out and ultimately benefit from the downswing of the rates going down, especially if you're in a variable that maybe you got in the late 2020, early 2021 year. That could be a very sharp discount currently. I mean, we were looking at variables at prime minus 1.3 to as high as 1.5% in some cases, and that's quite a sharp discount, and that might be a discount you don't want to give up. And so for that reason, you may want to hold on to that variable and ride the wave when it when we guess it's going to come. Now, the flip side of that is, you could be in a variable that's say prime minus 0.40%, which has been a more common discount on prime right now. Those types of variable rate clients may be, it may be too risky to hold on to that one and really hope that the rates go down, because what we've seen in the past is rates go up quickly in some cases, like we've seen in the last 12 months, but it's very rare that they'll go down quickly. So it may be a lot longer road down to getting to a point where you could be, as of today, if you just ultimately locked in, which we're going to touch on.
Yeah, only other couple items that come to mind for me is like, some people have been burned in the past with fixed rate mortgages because the penalties can be like massive, right? I'm talking like $30,000-$40,000 we've seen, depending on the size of the mortgage, length of term, everything else. And that can be a pretty frightening thought for people that have actually been through that and had to pay those penalties, or have ran into them and basically are forced to stay with the same lender, which ends up costing them more money in the long run. So I can understand that side of it. Some people just have a bit of a vendetta against fixed, as I'm sure a ton have a vendetta against variable right now. But the penalty conversation, like, it just depends on your situation, right? Like someone that might be selling, like if it's a rental or whatever, like if you're planning to sell that property in the next little bit, right? Like you want to leave that in a variable to keep your penalties low. If you had plans to refinance, but not right now. Like maybe you're waiting to get your job or what, like if you have plans to do something that has to do with changing or paying out your mortgage early, like you wouldn't want to take that jump into a fix because the penalties can be huge depending on where rates are when the time comes that you're actually breaking it. So again, just digging into your personal situation and your plans, like it could not align, right? I think that's pretty much it. Like Dean, that piece about like if you had a really good competitive discount on your variable, like if you're at prime minus 1.2 or prime minus 1.3, like don't get me wrong, nothing looks appealing right now. But if you're at prime minus 1.3, you're sitting at 5.65% roughly, if I did my math correctly. And like, again, rates could continue to hike a bit, but if they didn't, you're kind of in range with fixed rates anyways, right? So it's that unknown. Like, do I just ride it out because I kind of have what I'm going to get on a fix? You might get something a little bit cheaper depending on your lender and everything else, but you're kind of in range, right? So you got to look at that math, and do you take the risk and hope rates don't go up, right? Like, and that's what we've all been dealing with for the last year to year and a half here, right? It's just the unknown. And if you don't want to deal with that risk and like you can't stomach that and you don't want to sleep on it every night, that's probably where pushing into a short-term fix could make sense.
I'm not locking in anything right now. I have been burned by one of the big IRD penalties on a smaller mortgage with the fixed rate. So for me, the unknown is still worth it versus the big penalty I will incur.
That's one of the factors that you definitely need to consider. And one of the topics I wanted to just kind of get into here is if you ultimately are going to lock in, like you have to do that for various reasons, such as just controlling the payment. You're concerned that the payment's going to go up and beyond a point that you can afford. So like if we are in the mindset that we are going to move forward with a fixed rate, that the things to consider are that penalty structure that Justin mentioned, really being comfortable on how long you're going to be in this home. So let's assume that the payment that you're going into as the new fixed term is comfortable. Is your lifestyle going to keep you in that home for as many years as you're locking into? And if the answer is no, then maybe look at locking into a shorter term. Now, so just really understanding what your future is gonna look like is something that you're gonna have to check for yourself and really have a deep discussion with your family and your situation and ensuring that you're going to stay in that property. Also, it's an opportunity to look at other items that are going on in your life, like such as budgeting and is there a way to maybe lower your payment by extending the amortization? These are things that we wouldn't necessarily recommend unless it's really necessary to control the monthly costs. But also looking at unsecured debts, high interest car loans, like all of these things can be factored into the mortgage payment and can be consolidated, assuming there's the right amount of equity and it makes sense from an interest perspective, given what you might be paying on those other products. But those are things that you should really be looking at before signing any sort of a locked-in rate proposal. The easiest path of least resistance to lock in your variable to a fix is just calling the bank and getting their offer, and then signing whatever paperwork they send you, usually within the same day. By doing that, you eliminate all your ability to do any of what we're talking about here. And so definitely, call the bank, find out what they're offering, but certainly talk to us or a mortgage broker that can go through those options, because, once you lock in, back to the penalty structure, there is no ability to consolidate any of these debts until that fixed term is done without, looking at a very large, potentially very large penalty. So just really taking your time, no knee-jerk reactions is key. And one of the strategies we've been looking at is, understanding that this may be an opportunity for somebody that they may be considering doing this, but wanting more time, but also wanting to ensure that they don't lose the current fixed rate that's being offered to them. There are a lot of lenders that will allow you to hold a rate. And so looking at a rate hold while you investigate these options would also be a top piece of advice.
I think too, the rate hold piece is super important for anyone looking to get into the market right now. Once we saw the Bank of Canada announcement on Wednesday, the bond market quickly followed suit. So we are seeing fixed rates and variable rates kind of going up a little bit. So I had a conversation that was with a client yesterday who we had a rate hold in with a local credit union, and he decided to go talk to another lender, and we were 0.75 basis points away from where he was just offered. So a rate hold can help your qualification as a buyer. A rate hold right now can can help you just in general. We're seeing rates move up daily right now from all our lenders. So it could be the difference of you getting a little bit extra mortgage money to your condo, or it could be a couple $100 a month or something like that, right? So it's huge right now to make sure the pre-approval process is the best you can have, and that's what you get here at Thrive.
Yeah, 100%. And I mean, just back on this whole converting option, right? So understanding what your lender can do, like Dean mentioned, reach out to them to say, what can you offer? Always talk to us, because there are not many, but there are a few lenders, like even if you're one day into a 5-year variable, some of them can offer you a 3-year fixed from day one, right? And I think one of the biggest challenges right now that people face, like especially, anyone that bought in the last couple of years, if you're 1 or 2 years into your 5-year variable and your bank's offering you a 4 or 5-year fixed, right? Like it's not overly appealing to be locking in at these inflated rates for a really long period of time, right? The goal, and this will lead into our next and kind of last option for anyone in these situations, but not ideal if you're locking into something for a long period of time, because likely what will happen is, you lock into a 5-year fixed at 5.5 or whatever it might be. Rates probably will come back down. When, we don't know, but let's say it's in the next couple of years. If you're locked in for an additional 3 years at an inflated interest rate, you're probably going to want to get out of it. And this happened like thousands and thousands of people at COVID. When COVID hit, they locked in right as rates were going up. Rates shot down. We had conversations with hundreds of people, and their penalties were like $30,000, $35,000, $40,000, and it actually didn't make sense for them to break their mortgage early. So you're restricted from getting into that cheaper mortgage and saving money, right? So that's where just understanding what your lender options are and talking to us first. Like we've had a lot of clients that are with a lender that offers a 3-year from day one, but they call the bank and the bank only offers them a 5-year, right? So just understanding that strategy, like we're always going to be in your corner and make sure you get the best outcome from your lender. So just loop us in before you make any decisions, like Dean had mentioned. Other than that, yeah, like it's an easy process to do it. So if the rates and the payments make sense, it's, and you're comfortable with, the outcome. The best piece of advice I can give anyone going into a fixed at any time of your life, but like especially right now, if you're taking a 3-year fixed, just go into it the mindset that you're in that mortgage for 3 years, right? Like whether you're selling and buying, you probably need to port your mortgage because the penalty is going to be too high. If the rates drop and you try to refinance 2 years into a 3-year, like the penalty is probably going to be too high to make sense of it. So just go into it with the mindset that you have that rate, you have that payment for the full 3-year term. And if there is an opportunity, like we actually built a tool during COVID where we could plug in people's mortgage details, their penalty, and we could run the numbers and figure out where their break-even point was. Like some people actually consolidated big penalties, $15,000, $20,000 penalties, because we could show them the numbers that after 9 months they would break even, and everything after that would be a bonus, right? So, just you got to do your due diligence, right? The banks are, they're always, we need them to operate, we need them to finance our homes. Like there's a lot of good there, but there's also some of them just might not have the answers that you're looking for, and it's our job to know, what the lenders are offering too.
Yeah, those are great points, and probably a good point to end this discussion. I think we've touched on some really great options. I just want to put one piece of caution and another piece of advice out there before we wrap up. One would just be really understanding your budget. If any sort of concern around monthly costs when it comes to mortgage comes to mind first, of course, but just really understanding all the other costs, the Netflix cost, the car payment cost. If you're looking at any sort of adding any sort of cost to your portfolio, just really make sure you're looking at what exists first. And we have a great budgeting tool for anyone that wants to get access to that. We're happy to share it. And lastly, been seeing this a lot. Clients looking to buy a new car, just be really cautious of what those car loan rates are. Best rates right now for like AAA credit clients are looking at 7.99 to 8.99% on a car loan. And, car loans are, especially dealerships these days, are notorious for offering, rolling in debts, paying off, doing cashbacks and whatnot. Just keep in mind it's being rolled into a really high interest, and really consider looking at your mortgage situation before doing any sort of a major purchase like a car loan and taking on new debt like that. So just a piece of mind there. And I think again that it's been a great episode to talk about what we can control in a time where it's very very uncertain and hard to control really anything but what we have in front of us. So thanks for listening. We appreciate all your feedback and everyone that's following and liking our our content here. It goes a long way. It's what allows us to continue to do this. It's what motivates us to continue to do this type of show. So we appreciate that. And if you have any suggestions or feedback for us on future episodes, we're all ears. And we have some exciting announcements coming up too in the future that we look forward to bringing to you. And if you're not already subscribed to our newsletter, you're going to get a lot more up to date and quick information there. So please reach out, and we're happy to do this. Have a great day and take care.